Crypto hit $20 trillion in Q1 volume, and 90% of it was derivatives. Crypto markets handled roughly $20 trillion in total trading volume during Q1 2026, with approximately 90% flowing through derivatives rather than spot order books, according to data compiled by Coinglass and shared by Cointelegraph on April 4th. Binance dominated the quarter's activity across both segments. The ratio is stark. For every dollar traded in spot crypto, $9 moved through perpetual futures, options, and other leveraged instruments. That split has been widening for years, but Q1 2026 may mark the point where spot trading became a sideshow to the derivatives engine that now defines crypto market structure. $18 trillion in derivatives, under $2 trillion in spot. The approximate breakdown: derivatives accounted for around $18 trillion of the quarter's volume, leaving spot exchanges with roughly $2 trillion. March was the weakest month for spot, with centralized exchange spot volume sinking to $986 billion, the lowest reading since early 2024. Perpetual futures are the dominant instrument. Unlike traditional futures with expiry dates, perps let traders hold leveraged positions indefinitely, paying or receiving funding rates based on market imbalance. Exchanges like Binance, Bybit, and OKX offer up to 125x leverage on major pairs. Offshore platforms push even higher. The sheer volume of derivatives relative to spot matters because it changes how prices move. When 90% of trading is leveraged, liquidation cascades become the primary price-setting mechanism. A 3% spot move can trigger billions in forced closes, which then amplify the move further. Bitcoin's $10,700 BTC liquidation event earlier this year demonstrated exactly this dynamic. Binance's Quarter Binance led both spot and derivatives volume, consistent with its position over the past several years. The exchange has faced regulatory pressure in multiple jurisdictions, including a $10 million fine in Australia for misclassifying retail derivatives clients. But its market share has proven resilient. No single competitor has come close. Qcoin, now permanently barred from the US, and Bybit, still recovering from the Drift protocol exploit fallout, both lost ground in Q1. OKX maintained a solid second or third position, depending on the metric, but the gap to Binance remained wide. Decentralized exchanges are a different story. Cumulative DEX volume crossed $12.5 trillion in late March, an all-time milestone. Hyperliquid, which now handles over $1.2 billion in open interest across permissionless markets, has become the primary venue for on-chain derivatives trading. The $20 trillion Coinglass figure tracks centralized venues. Including DEX derivatives would push the total higher still. Why spot dried up? Multiple forces compressed spot volume simultaneously in Q1. Bitcoin closed its worst quarter since 2018, with 5 consecutive red months eroding the buy-the-dip reflex that sustained 2025 volumes. Crypto funds posted 5 straight weeks of outflows in March. The Fear and Greed Index reads 29, Fear, as of April 4th, with BTC at 66,949 and ETH at 2,051, both essentially flat over the past 24 hours. Retail traders, who drive the bulk of spot exchange activity, have largely stopped clicking buy. Institutional flows shifted toward Bitcoin ETFs and structured products, which show up in fund flow data rather than exchange spot volume. South Korea lost $60 billion in crypto to overseas exchanges in the second half of 2025, a capital migration that continued into Q1. Meanwhile, derivatives volume stayed elevated because leveraged traders operate differently. They trade on margin, use smaller capital bases to generate outsized notional volume, and tend to increase activity during volatile periods rather than retreat from them. A fearful market that repels spot buyers is often the exact environment that attracts perp traders looking to short. What a 90% derivatives market means the 90-10 derivatives to spot ratio has practical implications beyond the headline. Price discovery increasingly happens in derivatives markets, not spot. Funding rates, basis spreads, and open interest shifts now lead spot prices rather than follow them. Traders who only watch spot order books are seeing a lagging indicator. Regulatory exposure concentrates in derivatives. The The CFTC, which claims jurisdiction over crypto derivatives in the U.S., has been accelerating enforcement and pushing to bring perpetual futures onshore. The $18 trillion in quarterly derivatives volume gives the agency a strong argument for expanded oversight. For crypto card users spending from their portfolios, the derivatives-heavy market means spot liquidity is thinner than the headline volume suggests. Wider spreads on spot pairs can translate to slightly worse conversion rates when topping up a card from crypto holdings, particularly for mid-cap tokens with lower spot depth.